Good afternoon, everyone. I hope everybody is good after the weekend. I think we can start. Most of the class have already joined, and we will continue our subject, the long chapter, which is capital budgeting. Let me share the screen with you so that you can see it. Okay. So we said the risk analysis is divided into three parts. It was sensitivity analysis, scenario analysis, and simulation analysis. Sensitivity analysis, we define it that it is examining the effect of changes in specific variable and how it affects the NPV. But when it comes to scenario analysis, there is the changing in all the variables that you use in a model and how this affects the NPV. But when it comes to the simulation analysis, it involves the examining the effect on NPV when all uncertain input follow the respective probability distribution. So randomly, the numbers are changing, and what will be the NPV then? So we are given data parameters in here. We have specific project, which is 6 years in life. Investment in fixed capital, 300,000. Investment in net working capital, 50,000. Depreciation follows the straight line methodology, 50,000 each year. Unit price is $5. Sale in 1 year equals to 40 units, which is sold by $5 each. Variable cost per unit 1.5. Expected salvage value at the end of the termination is 60,000. Tax rate is 40%, and required rate of return is 12%. So we'll try to do Monte Carlo analysis using these data parameters. So we need to construct the model first, the capital budgeting model. But the green line that I underlined in here, which is gross sale and the standard deviation. But let me just construct, I'm going to come to this point so that we said that the sale in year one, it's 40 units, and which is sold by at $5 per unit. However, the growth of the sales, it grows by 5% with a standard deviation of 1%. So it will be changing 1% up, 1% down every year. But it's going to happen randomly. So we are not going to change it. So there's some formulation we'll use it in order to change it randomly. So the purpose of doing this is to get Monte Carlo simulation, Monte Carlo analysis. So we put the years. Okay, 0, 6 years. And of course, we need to find out what is the investment cost in fixed capital. We need to derive it back here. And we need to, the total cost, the investment total cost actually here. We can just calculate investment. Let me just put it like this. Total investment cost. So basically what we do here is 350. So I'm going to put it with the red. So from that perspective, I will put the growth rate. Growth rate. Growth rate. But the growth rate will be changing. The growth rate will be changing with the deviation of 1%. Okay? Randomly changing with 5%. So which means that So these changes will take the place randomly. Okay. So we need to put the growth rate sales of the average is this one, and standard deviation is this one. So it's randomly going to select the growth rate. Okay. If you put a percentage here, as you can see it, 5.76. So it will be deviating by up to 1% up and up to 1% down, around the 5%. So 5% is the mean. So it's going to happen for all years differently. So I'm going to fix this one. So it's norm.in rand. So this is the command you have to write in order to make the growth rate deviate around the mean by 1% using this function. But it should be doing it randomly. Every time you just press enter, it changes, as you can see here. Or press F9, it will be changing. Just by pressing F9, it changes, you see? Now, what we'll do here, for all years, the growth rate will be the changing. But if you press F9, the growth rate will be changing for all years simultaneously. Okay, but they're not the same. They don't go in the same direction. So next we should type sales. So we said the sales are 40 units in the first year. Okay, and next year it will grow by this rate. And this. Okay. So 40 times by 1, 1 plus this rate. This will give you the growth rate of the next year. Actually, this one we don't need it. This is the sales. Sales in units. Now we need to calculate the revenue. Revenues. The revenue is price per unit times the units itself. So price per unit is this $5 times this. So this times price per unit. But the price per unit should be fixed. Then I need to calculate the variable cost. And here we don't have the fixed cost, just for simplicity. Variable cost is the units produced times variable cost per unit, which should be fixed as well. So if you once you press F9, you see that all the numbers are changing. Can you see it? Okay. Or if you put here and press enter, it will change all the numbers simultaneously. So every time the numbers will be changing. So everybody will have its own calculation, its own results. So they will not be same. Depreciation. Okay, it's fixed for all years. It's fixed for all years. It's dollarized. Now we need to calculate EBIT, earnings before tax. So sales minus variable cost minus depreciation. This is we get earnings before tax. And it's the same for all. Then we calculate the tax rate. Tax is 40%. So 90 times 40. And now we can get OCF or operating cash flow after tax. OCF after tax equal to this minus this. And what we used to do before, we are adding the depreciation back. Depreciation back. So 50,000 should be added back. And our total operating cash flow. So let me call it as OCF again. After tax plus depreciation. And we have, of course, terminal non-operating cash flow. So the salvage value is 60. And so what we need to do here is the basics, like 60 minus 60 times the tax rate and plus change in net working capital. That we used to do it before. And of course, at the end, we have total operating cash flow, total operating cash flow with the investment cost here. Okay. Okay, this is what I get, total operating cash flow. Now, my turn is to calculate the NPV.
I'm sorry, could you show again TNOCF?
Yeah, sure. It's here. It's salvage value minus the amount the salvage value is being taxed plus investment in net working capital. So if I wanted to write it here, like 60 minus 60 times 0.40 minus, sorry, plus 50. This is
Thank you.
how we get the salvage value. This is expected salvage value, the amount which is being taxed, and plus the change in net working capital. Now we can calculate the NPV, and we can calculate IRR. So rate is 12%. The values are here, and minus investment cost. So our NPV is positive. Okay, I don't need to calculate now IRR. Okay, just let me skip it. So what I do here next, I need to calculate. Now I will have to create, actually this is what we did, is not yet Monte Carlo analysis. What is called Monte Carlo analysis, you will see it now. When we simulate the same NPV 10,000 times, okay, 10,000 times. So NPV, so sample first of all, and MPV itself. So from 1, okay, let me make it 1000. So we will now get 10,000 different, sorry, 1,000 different MPVs. By this is what we call Monte Carlo analysis, simulation analysis. We'll simulate, okay? We'll see how it will change. Now, to do that, we have to go to data, what if analysis, data table, data, data table, what if analysis, data table. So in here you have row input cell and column input cell. So which means that where you want to put your results down. I mean, where you want to simulate your NPV. You want it to row or column. Of course, we have to select the column. We have to select the column input cell. So we press OK. Now our NPV is simulated, as you can see, 1,000 times, 1,000 times. Different. So changing the variable cost, changing the cell units, changing the tax rate, and everything is changing simultaneously by randomly. And we did it 1,000 times. F9, one more time. F9, one more time. F9, one more time. Okay, this is how we call as simulation. Okay, one thing I don't have it here, descriptive statistics. This is what I needed actually. So what I do here, to do the descriptive statistics, I need to make some add-ins. Okay, I don't have it in here. I will do it, and you
I'm
have.
sorry.
Yes,
Could you show again how to make what if analysis?
sure, sure, definitely. So first we create sample from 1 to 1,000. Okay.
Yeah, I got just
Okay.
the last step.
Okay. Then we select again. This is empty. Okay. The right column is empty. Then we go to what if analysis, data table, press on this. In the column cell, input cell, we have to select this MPV column, okay? Column input cell, you select this one, and it automatically do the MPV estimation for 1,000 times by pressing OK. Is that okay?
Yeah, thank
Okay.
you.
Now, in here, we need to add the descriptive statistics in order to do the estimation for descriptive statistics. Why we need to make the descriptive statistic is to see how valid this Monte Carlo analysis is, okay? The validation of the Monte Carlo analysis, whether the distribution of this Monte Carlo analysis is proper. Now, go to File, Options. I think it was in here, Add-ins. Just a second. Okay, we don't have it here. Analysis toolpack, yes. VBA, this is what I needed. Okay. Okay. Can you see my data analysis added here? So I go to option. If somebody doesn't have, please, if you're next to your computer, open it, the Excel file. Try to see whether you have this data analysis on your Excel. Some may not have it, some have it directly installed. Please check it and give me a feedback. If you don't have it, what you need to do, go to File, Options, Add-ins, and select Analysis Toolbar here, okay? Once you select it, go, click, and press OK. It will be there directly. Okay, the next step to do the data analysis, descriptive statistics, we need to just select this. We selected all, data analysis, descriptive statistics. Okay. Now input range, actually here, all the MPVs you calculated. And for the output range, you can select either to go in the same worksheet or to create a new worksheet or create a, how do you call it, a new workbook itself. Okay, let's do it as a new work or in the same range. Okay, we'll do it in the same range. Like here, I want to go the results to appear in here, not as a new worksheet, but in here. But I selected the wrong one. So for the output range, okay, this is the range that my results will appear. And I think I have to press just OK. Yes. As you can see here. This is my results. And this is, we need to be able to interpret it like mean. Actually, what is important here, we're going to interpret the mean. We're going to use this standard deviation, skewness, kurtosis, range, minimum and maximum. So in here, to make our NPV to be valid, okay, our average mean, so our average NPV out of 1,000 simulation is equal to 161. And what is the range between the NPV we calculated and the NPV as average estimation? We need to just take the difference, 165 minus this. As you can see, the range actually is not that much big, okay? It's not that much big, $2, $1, so it's negative, it's okay. So that means our estimation, simulation of 1,000 different NPVs doesn't get much far away from real NPV. And Coming to standard deviation, the lower the number, the better the position of the validity of this estimation. So the riskiness of the project, how it deviates around the mean, okay? And kurtosis and skewness, there is a range that you should take into consideration while making this evaluation, which is called, in here in kurtosis, it should be from -2 until 2. From -1 to 1. So if it falls within this range, then the model follows a normal distribution. So that means the model is okay. So we can rely on this model. The kurtosis and the skewness. So the range between the maximum and minimum is 31. So the minimum value of NPV is 143. And the maximum value of the NPV 174. It's good, actually. The lowest NPV you could ever had it in this project is 143 million or 143,000. It's good. It's very nice. And the maximum is 174. So that means having all 1,000 different scenarios will not bring us any NPV which is negative. But one thing in here, because the standard deviation of the gross sale is not that much big. If it was, let's say, 3%, look how the NPV changes. But we need to make from the beginning again the descriptive statistics. That will change the NPV as well, because this is the already taking the result, okay? But so it depends on the how it deviates the gross sale itself. Okay, this is the called the Monte Carlo analysis. Let me save this file so that I can download, upload it to Moodle. Monte Carlo analysis. Okay, we're recording. Okay, give me a second. Let me take the attendance and then we can continue. One more time, the attendance will be graded. I will give you 5 points in total for full attendance that you attended from the point that I started to take the attendance, actually. Sanjar is here? Okay. Islam?
I'm here.
Aiday?
Here.
Here, good. Yasmin?
Here.
Very good. Jean? Okay. Nias?
Yes, I'm here. I'm here, Professor.
Okay, Jean is here. Good. Nias is here.
I'm here.
Tomiris? Tomiris? Yerzat?
Here.
Gablugani?
Here.
Raushan? Okay, Raushan is not here. Binura? Aidana?
Here.
Begzat?
I'm here.
Zirui?
I'm here.
Professor, my name is Askarbekova Tamiris. I'm here.
Where have you been, Tamiris?
I'm sorry, I had problems with my phone. I couldn't hear well.
Okay.
Me too, Professor Bulatova Binura. I had problems with microphone.
Okay. Daujan?
I'm here.
Eldar.
I'm here.
Okay. Aydos. Gani. Artur. Gaziz.
I'm here.
Baglan.
I'm here, Professor.
Good. Zarina.
I'm here.
Abdurrahim.
Here.
Rayhan.
I'm here.
Alibek. Danyar. Danyar is here? No. Sanjana.
I'm here.
Dalirhan.
Here.
Klesho Baglan.
Here.
Okay. Milana.
Here.
Arnur.
Here.
Ilya.
I'm
Okay.
here.
Daniel.
Sorry, Professor, I'm here.
Daniel here. Good. Vladislav. Umarov.
I'm here.
Diana.
Here.
Uralova. Clementi.
I'm here.
Okay. Janelle.
I'm here.
Camila. And Adilhan.
I'm here, Professor.
Okay. That's great. And want to
Professor.
make... Yes, there's somebody who's saying anything. Yes, please.
Can you check me? Ghani Mukir.
Gani, I think I checked you. Yeah.
I'm here, Professor.
Okay.
Thanks.
You're welcome. Now, I want to tell you something that, first of all, on Wednesday, it means 7th, the day after tomorrow, you'll have a quiz. Okay? So you have to study quiz. The quiz will be the multiple choice. 5 questions from the multiple choice. You have to do that multiple choice questions. And this is the first thing. And second thing, on Saturday, which is 10th of October, I invited the owner of the Tengri Partners company. I invited the owners of the Tengri Partners company. Tengri Partners is the investment banking. Whatever we do anything in here in this course, they are doing in real market. So I asked him to do the presentation, like every subject that we teach in here, he will do the presentation, what they do. So we'll try to kind of connect the theory with the practice. Because what I realized, the students, when they graduate, they are not prepared for their working field. So they have to study again from the beginning, like around 6 months. The same thing, was supported by this investment banking owner. He said, yes, that's very true. We hired 2 Kimepian students and we taught them 6 months more. We educated them 6 months more. So at least somehow to make you ready from the corporate finance, at least from here. So at the end of the course, he will select 2 or 3 students to do the internship in his investment banking company. It's a very big investment banking. It's a Tengri Partners. Let me just type it and so that you can see it. So they're doing this trading in financial market. They're doing this capital budgeting and so on. So all the topics we do, they will do the presentation. They will give us different cases from the real market, from the real industry, what they have been involved in. So at least you will be familiar with all what they are involved in actually. So be aware of it. Saturday, 11 o'clock. Don't miss it, please. Okay, don't miss it. And
Saturday at what time? Sorry.
11.
Okay, thanks.
Saturday 11. Please don't miss it. It's a very good opportunity for you, first of all, to get the knowledge from the real market. Try to connect the theory, whatever you learn it here, try to connect with the real market.
Professor, may I ask the question
Yes, please.
regarding the quiz? Is it going to be based on all the chapters we've covered or just the last ones?
We didn't cover any chapter. We still working in the same chapter. As you can see here, we covered 62 slides, and it's a very long chapter. And it will be based from the beginning till now. So the questions I gave you to solve 10 questions. You remember?
Yeah.
I'm going to provide the solution to you for those questions. You can work out again. Kind of make you prepare yourself for the quiz. So the questions will be similar to the end of the chapter questions, multiple choice questions.
Okay, thank you.
Okay.
Sorry, can I ask a question about quiz? It's on Moodle, right?
Yeah, it's going to be in the Moodle, on the Moodle.
Yes. We have to finish it today. Yes?
No. The quiz on Wednesday.
It's quiz on Wednesday. When is my midterm?
Wait for the midterm. I have to finish the chapter. I have to finish the chapter.
Okay.
I have to finish the chapter. We talk about the midterm later. So now for today, you are announced the quiz.
Professor,
Yes.
what about time limit of quiz?
I will see. I think each question will be given 3 minutes. It's actually basically you need 1 minute to calculate, but you will be given 3 minutes each quiz, and in the quiz you will not have a chance to go back to the previous question. You have to solve it and move to the next. So you have to be very careful about this. The quiz will be straightforward. Whatever you have seen in the class, you will be responsible for that. Nothing more, nothing beyond the schedule. Exactly similar questions.
Will it wait? Sorry.
Yes?
5 points?
Yeah, it's 5 points. The grading is 5 points.
What about those quizzes that we already had? Are they graded?
Of course. Everything is graded. Let me explain it one more time to you. Just a second. Here. 5 points, 25 points. Quiz 1, exam 1, assessment 1, total 30 points. This makes assessment 1. Assessment 2, similar way. Assessment 3, activities. So these are the activities, okay? You will have in total 10 activities, okay? In total, you will get this 10 points out of 10 activities. The correctness of the activity is not graded, only the participation of the activity is graded. This is what you should know. Then, for the last moment, I received notification from the dean office that I have to take the attendance regularly. And so I decided to take it and to give some points for that, 5 points. These 5 points will come from the final exam. So the final exam will be 25 points and attendance will be 5 points. In total, the assessment 3 will be 40 points. Is that clear?
Yes.
Yep.
Yes.
Okay.
May I ask?
Yes, please. Sure.
So for activity, we should just upload the file.
You should just upload, not just file with solution. More.
Yeah, I mean with solution,
Yes.
but it will not be graded like.
For correctness, whether it's correct or not. I want you to do it on yourself.
Yeah, I mean this one.
Okay. So if you uploaded 10 activities, even let's say 8 of them are not correct in calculation, there's some mistakes, still you will get 10 points. Okay. I think everything is clear from now. Let's move further. Okay, this Monte Carlo analysis, I will upload it in the Moodle. The video will be available in Moodle as well from today. So I want to continue. Okay, this we did it. Simulation analysis, we did it, okay. Okay. Some real options. So real options actually allow the managers to make future decisions that will change the value of the capital budgeting decision made today, actually. Real options are similar to the financial call and the put options, that they give the option holder the rights, but not the obligation to make a certain decision on a certain project. So the real option offers the managers the flexibility that can improve the NPV estimates for specific projects. There's some types of the real options like abandonment options, expansion contraction options, and growth options, flexibility options. So talking about the abandonment options, it allows the management to abandon a project if the present value of the incremental cash flows from going out of the project will be more than the present value of the incremental cash flow from continuing the project. Okay, example. You have decided to run the project, let's say 3 years. 1, 2, 2, 3 years, okay? The project will be running 3 years. In here, some investment cost, let's say 100. Well, let me do it in Excel. That will be more clear. Here. So minus 100, 200, 200, 200. So abandonment project says, if you decided to exit the project in year 1, let's say you said, I'm going to terminate the project, I'm not going to continue because the cash flows are not really good. They will not make my NPV to work out. And your salvage value will be, let's say, 300 here. Just an example. So that means if you stop here and you sell it, so that means the present value of this cash flows should be the greater the present value of the future coming the projects. So here's the explanation in more details. The present value of incremental cash flow from exiting the project, so which means that the present value of this value exceed the present value of incremental cash flow from a continuing project. Exceed the continuing project. So if this part and this part, this is you exceed the project and this is you continue project. If you exceed the project, that means you will abandon the project if the present value of these cash flows will be more than present value of these cash flows. In this way, you will exit the project. This is called a kind of abandoned project, okay? So present value of incremental cash flow from exiting the project will exceed the present value of the incremental cash flow from continuing project. So that will lead the management to abandon a project. Expansion or contraction options allow to increase or decrease the scale of an operation in response to demand. Growth option, it allows to expand the scope of activities to capitalize on new perceived opportunities. And flexibility option gives the manager choices regarding the operational aspects of the project. Like two main forms are price setting and production flexibility options. So price setting options allows the company to change the price of the product. For example, the company may increase the price if the demand for product is high in order to benefit from the demand without increasing the production. Production flexibility option, it uses different materials as inputs or produce the different variety products. So alternative treatment for analysis project with a real option. So use NPV without consideration real options. If positive, real options would not change the decision. This is obvious. However, if you get your NPV negative, then if you use the real options, that will change your decision actually. That might change. So estimate the overall NPV. If NPV get negative, then you should make use of real options, where you have to estimate the overall NPV, which is equal project NPV without option minus cost of real options plus value of the real options. And that will give you the estimation of the overall NPV. So we'll have an example and you can understand better. Okay, this is production flexibility option. ABC Incorporation has estimated that NPV of the expected cash flow from a new production facility produced the classic yachts is negative, which is 8 million. Black Pearl's production manager is evaluating an additional investment of 5 million in equipment that would give the management flexibility to switch between the classic, deluxe, and elite models of yachts, depending on demand, of course. The option to switch the production among the models is estimated to have value of $15 million. So evaluate the profitability of the project, including the real option. So here how they do it. Overall NPV is the project NPV minus option cost plus option value. Very straightforward. Overall NPV, so negative NPV here, minus extra cost that you put it, and plus optional value. So overall NPV will be equal to 2 million. So without the option, the NPV of the production is negative. So we don't accept. However, when we employ the real option, like flexibility option, this real option adds the enough value to make a positive decision on this project that will underline the profitability of this project. It's just straightforward using the formulation, okay, here. This is the main formula that we calculate. Okay, let's move further. A 3-year project with a project cost of capital of 14%, the initial investment is 1,000. The expected cash flow are 400. So a 3 years project, let me put it down. In year 0, we have 1,000 investment. In year 1, 400. In year 2, 400. In year 3, 400. This is how much we generate using specific project. So this is additional information, okay? Based on the discounted cash flow, the analysis of NPV is equal to, okay, I think is the best. Let me put it here. Oops, sorry. Okay. And if you calculate the NPV using the discount rate of 14%, your NPV will be equal to a negative number, minus $71.35. However, there's some additional information given. Instead that we have more information on expected cash flows, first there is a probability of 50% that the cash flow will be 200 and the probability remaining will be 600. So kind of success scenario and the failure scenario. So the expected cash flow are still 400. So in addition, at the end of the first year, we'll know whether the project is success, which is 600, or failure. So we have the option to abandon the project at the end of the first year and receive the salvage value of 650. So let's see what happens. So in the case of failure, it says that, okay, 1,000 investment, but 200, 200, 200. This is how much you get it. And MPV, in this case, will be equal to, if you calculate MPV, it's different. Okay, we'll calculate the MPV later, but let me just put it for success case. Now, first of all, as we said that in order to abandon project, we need to evaluate to see that present value of cash flow from quitting the project, from exiting the project, should be greater than the project, the present value of the cash flow from the continuing project. This is what we have underlined actually. So in order to do that, we need to compare with the success and with the failure case. So in here they say the salvage value is $650. So that means the $650, okay, let me make it like this, more clear. This is the point. Oops, okay. So this is the point where we exit the project after 1 year and we don't continue. So let's compare. What will be the MPV? What will be the MPV in the first scenario? Like we have here $650 additional cash flow. $650. Okay. If we exit the firm. So the MPV, so in order to compute the MPV of the future cash flows, we need to just take the present value of this cash flow and calculate it to bring it here to compare with $650, whether it's higher or less on that. So what we do in here, so MPV is equal to minus 1,000, the cost, plus $200 plus $650, and this divided to the 1 plus 0.14, or let me make it like this, 1.14 1.14, which makes, let me just calculate. I think we should have calculated directly using the Excel. That would give us. Is there anyone has got the calculator next to hands? Please calculate.
Minus 254.
Thank you so much. Thank you so much.
0.39.
0.39. Okay. Okay. And we do the same thing. $254. if we exit the project, okay, in the case, let me just put it like this, case of failure, and this is case of success. My MPV is equal to minus 1000 plus. So as we here, we exit the project, okay, and we try to calculate the MPV of this. Is this much. However, we have different scenarios. If it was only this, then we would just end up and try to compare with the continuum project MPV. However, we are not in this case. We have different scenarios, so we need to calculate for both scenarios MPV. In the case of success, we do not exit the project because it's a success project. It shows that you will be succeeded in this, so there is no need to stop and exit the project, so you will just continue your project. So 600 divided by 1.14 plus 600 divided by 1.14 to the power of 2 and plus 600 divided by 1.14 to the power of 3. Okay, please help me to get the answer.
$392.98.
Just a second. Oh my gosh. Everything is gone. Okay. Anyway, we have the results in the next slides. My computer is, I don't know what happened. Just let me make it again. So what we do here, NPV failure is equal to minus 254.39, if I'm not remembering correctly. Correct me, please. MPV success is equal to 392.98, almost 93. Okay, this is, we get it in the case of success. So what are we doing here? Basically, we need to just calculate overall MPV with a probability value 254 minus 0.39 times the probability value plus 392.98 times 50. And so whatever MPV we get here, we go with that. So can you calculate, please? $29. So we accept the project. We accept the, according to the results that we get from the order. So our decision should be to accept the project. However, if we didn't have our this case, if we didn't have the case of success and only failure case, then we will abandon project if the cash flow from remaining years will be less than present value of the cash flows from exiting the project. Then we could just compare with that. But in here we have success, so the overall NPV is this one. So our decision is to accept the project. Okay, here they have it. As you can see, we did the same thing. So the value abandonment of the option, at the end, we have not done it, but we can continue doing it. So to find the abandonment option, we should add the real NPV that was calculated. So the value of the abandonment option is 140,000. So abandonment option has made the project viable. So we should now accept it because the NPV is greater than 0. Okay. Now, one more thing about the quiz, if I didn't forget. Okay. This what you have to solve. The similar outlays, NPV 12, 13, 16 with discount results. Connected this project with multiple errors. Okay. Okay, until question 23. Work out these questions, okay? Even this 24, 25, 26. Just work out these questions. Just work out until 23. And please read the slides and everything. Just prepare yourself doing this.
Sorry, can you please show the page as well?
It's 140, 134, 134. It's from 134 till 138.
Should we practice until 23?
Yes, practice until 23 and read all the materials that we done so far until this. But the main part is to go with the slides, but the slides is directly taken from the book actually. Just practice your questions on here.
We should do it now and upload you?
No, not now. No, it's not active. I'm telling you to practice it at home for the quiz.
Okay.
We have the quiz on Wednesday.
Okay, thank you.
You're welcome. Now, assessment. Okay, we done this so far, and what is left here? The common capital budgeting pitfalls, disadvantages are listed here. Like they're not incorporating economic responses into the investment analysis. That means that template errors, because hundreds of or even thousands of projects that need to be analyzed over the time. The corporation made some standardization in the capital budgeting templates for managers. And this situation actually creates risk using these templates that has been created and standardized by the corporations, and that will not let them to match the project actually. And employers may input the inappropriate information. So this is the main problem. So basing investment decision on APS or net income and return, it's another story. Like managers sometimes have incentive to boost earnings per share, net income and return on equity, and many investment, even those with strong NPVs, do not increase actual accounting numbers in short run, and they may even reduce them. So paying attention to the short run accounting numbers can result in choosing projects that are not really suitable. Using IRR to make investment decision. We already talked a lot about the IRR that there are not really convenient measurement in investment criteria. Poor cash flow estimation, misestimation of the overhead costs, using incorrect discount rates, spending all of the investment budget just because it is available. So you have to be very rational and very efficient in using the budget, and improper handling the sunk cost. So I want to stop here. Next, when we meet, we will continue and we will finish the chapter. When we continue, we will finish the chapter. Actually, there are only 10 pages left. There's economic income and so on. So I want to stop here. If you have any questions, please feel free to ask. If not, I wish you good luck.
Sorry, Professor.
Yes, please.
Where we can find answers of those multiple questions?
I'm gonna send you tonight. Okay, I'm gonna put it in Moodle.
Okay, thank you.
Will you also include theoretical material in the quiz?
So in the quiz from the multiple choice, go over the multiple choice.
I mean, just calculations, right?
Yeah, just calculation.
Okay, thank you so much.
You're welcome. But for the exam, everything will be included. Theoretical, and the calculation.
Okay.
Okay, thank you. Bye.
Thank you.
Thank you.
Bye.
Bye.
Thank you. Have a nice
Thank you.
You too,
Goodbye.
guys. You too, guys. Good luck.